Welcome to The Explainer. Today, we're unpacking a pretty fascinating piece of financial alchemy, how you can actually turn a burdensome corporate loan into equity shares. If you are dealing with startup working capital, this is an absolute lifesaver. But, and this is a big but, it only works if you follow the legal framework to the absolute letter. So, can a company really just extinguish a loan obligation without paying back a single cent of cash? Well, picture this for a second. Sarah is a startup founder, and she borrows some working capital from her directors. Instead of draining her precious hard-earned cash reserves to pay them back, she essentially waves a legal magic wand and offers them shares in the company instead. Sounds kind of incredible, right? But to avoid some really expensive missteps, you need a plan. So our roadmap today will cover turning debt into equity, the pre-approval golden rule, a tale of two phases, beware the tax trap, and finally, common and costly mistakes. Let's dive right in. Part 1, turning debt into equity. This brings us right to Section 62(3) of the Companies Act. Normally issuing new shares is just a grueling rights issue process. It takes forever. But Section 63, it acts like a VIP fast track for founders like Sarah. You get to completely bypass the standard rigmarole, but, and you've got to remember this, you only get to do this if the option to convert that loan into equity was baked into the agreement from day one. What's really interesting here is the balancing act. It's like a seesaw of benefits and drawbacks. For the company, obviously, it's a massive win. The debt just vanishes, no cash leaves the bank, and your balance sheet looks instantly better. But the lender, they take on serious market risk now, and they lose their priority spot if the company liquidates. And the existing shareholders? Well, they just have to swallow the reality that their ownership is getting diluted. Part 2, the pre-approval golden rule. 75%. That is your magic number. You need a special resolution passed by a 75% majority vote from your shareholders just to approve this conversion option. A quick handshake among the board of directors? Yeah, that absolutely won't cut it. And the law is totally unforgiving about the timeline here. This special resolution literally must happen before a single cent of the loan hits your bank account. You can't just wake up a year later and decide to turn some old debt into equity. If Sarah skipped this pre-approval step before taking the funds, the Section 62(3) door is permanently locked for her. Part 3, a tale of two phases. So let's look at how this builds into a sort of chronological how-to guide. Phase 1 is strictly about accepting the loan. You hold your board meeting and your EGM to secure that 75% approval we just talked about. Then you draft a highly specific loan conversion agreement. Finally, you file Form MGT-14 with the ROC within 30 days. Only after all of that do you actually accept the money. Now, a really crucial distinction to keep in mind. While most director loans to startups are unsecured, sometimes they aren't. If your loan happens to be secured, the lender must formally consent to release that security, and you have to file Form CHG-4. If you skip this, an unsatisfied charge just lingers on your public record, and trust me, that is a massive red flag for any future investors looking at your books. Fast forward to Phase 2, the actual conversion. This is where a registered valuer determines the fair price as of today, the board officially allots the shares, and you file Form PAS-3 within 30 days. Then you just issue the certificates and pay the stamp duty. Notice what's missing here? Right, no new shareholder vote. You don't need one because they already gave you their blessing way back in Phase 1. Part 4, beware the tax trap. Okay, things are about to get very serious because Phase 2 introduces a hidden danger that can honestly financially ruin an unprepared lender. Enter Section 5622X of the Income Tax Act. Let's go back to Sarah. Say her director loaned her 50 lakh rupees. 2 years later, they convert it, but the startup's valuation has completely skyrocketed since then. If you try to convert at the old, lower price, the tax department views that massive difference in value as a deemed gift. And yes, that is fully taxable as income from other sources. This right here is exactly why that registered valuer's report is not optional. Skipping that conversion date valuation to save a few bucks on compliance, that could trigger devastating tax penalties of up to 200% on underreported income years later. So you have to ensure the conversion price aligns with the current fair market value, or you're setting yourself up for a nightmare. Part 5, common and costly mistakes. Let's recap the operational pitfalls. This is your definitive what not to do checklist. We already know about jumping the gun on receiving funds, skipping valuations, and leaving stale charges on your record. But one administrative oversight catches almost everyone: the annual DPT-3 filing. Even if your conversion process is totally flawless, you still have to declare exempted deposits, like director loans, by June 30th every year, or you're going to create a tangled compliance mess. And speaking of messes, administrative delays are expensive. Just simply forgetting to file your MGT-14 within 30 days of that special resolution triggers a penalty of 100 rupees per day. That might not sound like a lot, but it maxes out at a completely avoidable 5 lakh rupees for the company, not to mention personal penalties for the directors. So what if you're listening to this right now and realizing, oops, we already messed up phase 1? Well, since you can't fix it retroactively under Section 62(3), you have to pivot. You could just repay the loan entirely in cash, or you're looking at a fresh rights issue or a preferential allotment where the lender is treated as a brand new investor. And that brings a heavy burden of fresh valuations and some very strict compliance hurdles. As we wrap up this explainer, you might be wondering about buyer's remorse. What if the shares are allotted, all the forms are filed, and then someone just changes their mind? Can you just hit undo? The answer is a hard, absolute no. The conversion is permanent. The only legal reversal is a highly complex share buyback process that requires free reserves and a mountain of red tape, which leaves you with the single most vital takeaway of this explainer. Since you cannot reverse it, you have to get the compliance right the very first time. So I'll leave you with this question. Look at your cap tables and loan agreements right now. Are your past conversions truly compliant, or is there a tax trap waiting to be uncovered in your next audit?